Yes, good evening, Rick. And this is the Anderson Report. This is Friday, August 21. I want to thank everyone for joining us this evening. Says live in 2 minutes. And bear with me. We're still trying to work out a few technical difficulties that we had from a week ago when the chat basically stopped working on our streaming service. But we've got a workaround on it right now. I see a couple people in the chat. John is here. Rick is here. Really appreciate you guys joining us on a Friday evening. Number of things to talk about. Quite a bit of interesting action this week, although by the end of the week, averages were pretty flat. Not a whole lot of movement on the week in aggregate, but there's a couple of dynamics going on, frankly, that I find a little concerning and slanting, maybe slightly negative on the market for the next week. There's 1 week left in the month. There's really 2 weeks before Labor Day, so there's probably 2 weeks left in the summer. Labor Day is quite late this year. It is, I believe, September 7th or 6th, and that's the first Monday in September. So we've got, the good news is we've got 2 weeks left in the summer. The weather has still been pretty favorable in the Northeast and along the East Coast. Clearly, unseasonably and uncomfortably hot in the West. But we'll do a little bit of an intro again, give some people a chance to get tuned in. This is the Anderson Report. This is my YouTube channel, The Anderson Report. We come to you maybe for about 5 days a week or so. Might take a couple of days off next week. But if you have not yet subscribed, please hit the subscribe button on the YouTube page for the Anderson Report. Hit the little bell next to it. You'll get notifications of when the next show is going to take place. And of course, like the broadcast if you like it. This also goes out on Periscope. My Periscope TV channel is TJ Anderson 12. And my Twitter handle is TJ Anderson 1. Now, the one thing that I will mention about Periscope, and if that's where you're watching, that's great. Where I'm thrilled to have you watching the show. What I'm doing is to resolve this workaround issue with the chat not showing up in the streaming service I use. If you're watching on Periscope, I will not see you in the chat. Basically, what I've got going on is right in front of me, but slightly off camera, I've got my tablet running with the YouTube broadcast in it. I can see that Rick is in the chat. I see that John is in the chat. I might the what you put in might be 30 to 45 seconds delayed. I will glance at it from time to time and then get to it. But if you are watching on Periscope and you are putting comments in Periscope, unfortunately, I will not see them. We anticipate that we're going to have this resolved by next week. If I have to put up a separate device and watch the chat in Periscope also, I will. But I don't want to have these 20 to 30 second pauses in the broadcast that some people have while they're checking multiple devices to see who's commenting or if they're getting any worthwhile questions or comments from different venues that they're streaming to. So look, today, the market was we had one piece of economic data today that turned out to be really a blockbuster story that's not a brand new story, but it just crystallized today how strong the housing and home building market is. And it's not a blip. It's gonna go on for months into the end of the year, I would say, until things um, slow down, maybe due to weather in the depths of winter. But it probably won't affect the West, might not affect the South as much as it would the Northeast and the Midwest. And markets were under a little bit of pressure. This report until this report came out, and then they opened with a positive tone after the Dow had pulled back slightly over the last 2 or 3 days. The one average that did not reverse was the Russell. That's a little bothersome. We'll get to that in a minute. Um, and where the Dow gained a little bit less than 1%, up close to 200 points, challenging that 28,000 level again, 27,930. The S&P gained 11 points, challenging that 3,400 level again at 3397. Both the S&P and the NASDAQ closed at a new all-time high. For the NASDAQ, I think it was the third time this week. 11,311. Kind of one of those funny numbers that's the same if you look at it forward or backward. 11,311 spot 80 to be specific, up about 50 points. That's an increase of 0.4%. The Dow was pretty much flat on the week, very flat on the week. It was down by less than 1 point for a 28,000 index. That's flat. The S&P 500 was up 0.7%. Obviously posted 3 new all-time highs. And the NASDAQ, of course, driven by, you guessed it, the stocks leading the internet traffic trade. NVIDIA reported earnings earlier in the week. NASDAQ up 2.6% for, what was it? It's 35th, 36th high of the year. Transports, just the slightest pullback on the week, down 2%. But they gained 50 points today, and they're at 10,940. For an index that went from 10,000 to 11,000 in a very, very short period of time, I think 8 or 9 days, for it still to be very close to 11,000 is pretty astounding, especially given that the fact that the airlines kind of lost that rally they had a week and a half to 2 weeks ago and have not participated at all. Now, the Russell 2000, that's what really kind of bothers me because it's been down 3 of the last 4 days. It was down 0.75% today. It went out just above 1150 at 1152 spot 50. It was down 1.6% on the week. That was certainly reflected in the market internals, or the breadth numbers for the market, where we had decliners in lead advancers, declining issues, lead advancing issues by a little bit more than 2 to 1 on both the New York Stock Exchange and NASDAQ. That means there were 2 stocks down for every 1 up. There are a little over about 2,000 stocks declined, about 1,000 advanced. NASDAQ, you could increase those numbers by each a couple of hundred. Not really good. I am sure you will hear, if you are someone that really follows what a lot of the market watchers and the savvy market commentators are saying on the internet over the weekend, I am sure you will see a number of people comment negatively on the breadth of the market and the participation and the downside action of the Russell and or probably the S&P small cap index or the S&P 600. Now this could work its way through. This could not. This could be something that's worked out. The Russell could recover. You know, we had that one day where it went down, looked like there was a program out there where a big manager was selling small caps and buying other things. And then the following day, that was completely reversed, really until the last hour of the day when, excuse me, when we had the Fed meeting, the Fed minutes released on Wednesday, and they were very cautious, which they're always going to be, um, especially after a very, very, very strong advance in the market and maybe a half to three quarters V-shaped recovery in the economy, with the economy spiking sharply for the last maybe 2.5 months off the lows. If it can continue from this level, that will be challenging. It's probably going to stall for maybe a month, but uh, we will see. But the people that comment on the market breadth intelligently on the internet. And if you ask me to point one out, I would start front and center with a woman named Helene Meisler, who worked for Goldman Sachs and a few other big bulge bracket firms in the strategic equity and options department. I do not know her personally, but I have followed her. She writes for Real Money, and she posts very good stuff on Twitter, a combination of Friday evenings and Saturday mornings. I believe it's at H Meisler, Meisler. She's a very, very highly followed, intelligent market commentator that puts up a lot of charts, a lot of data, a lot of bullish, bearish stuff, a lot of stuff on the put call ratio, a lot of overbought, oversold, net advance declines. Really good stuff. So if you're asking me for one area maybe to go for that, that's where I'd go. I'd go to her, at H Meisler on Twitter. She writes for Real Money. I don't believe she does podcasts or video type stuff. Um, but the stuff that she puts on Twitter is very well done. So, why did the market? Well, why did the market not really? I was bothered by the market today. But let's go to something that I was not bothered by, and that was the existing home sales report for July, which was just a hit out of the park over the center field fence. The ball's probably still bouncing 2 or 3 blocks away from the ballpark. It was just an astounding report. Existing home sales in July at an annual rate 5.86 million versus an annual rate of 5.35 million last month. Now, I don't know if that was a record or a 14-year high or what it was, but it's just a sick, in the positive way, using the word sick as an extraordinary adjective to the positive. This was a sick report. Okay. You had the largest month. Oh, look at this. The largest monthly increase on record, which beat the prior largest monthly increase on record for existing home sales, which was last month in June of 2020. Now, the reason I emphasize that is because this is not a blip. You've got mortgage rates below a touch. You've got mortgage rates around 3%. Okay. You've got a tremendous amount of people that are looking to move out of the cities that have been overrun by this, ridiculous defund the police, not just talk, but action, and crime waves, rioting, destruction, hassling of people eating uh, evening meals at outdoor dining where it's not allowed indoors yet, and people who have been city dwellers, dedicated city dwellers for decades, um, and never would have imagined moving out of cities. New York would be the best example. Um, just saying, you know what, I've had it, I'm moving out. So you've got bidding wars for houses in suburbs, outside of the city, and maybe even a little bit beyond, and maybe even some people saying, "Look, I've been working at home for the last 4 or 5 months. Maybe I don't really need to go in the office. And if I don't need to go into the office, I don't need to live in New York City, which is a 10 or 15, 20-minute walk from my office, or a 20 to 25-minute subway ride, or a very, very short Uber or taxi ride. I can live an hour and a half outside of the city, and maybe go in when there's a very, very important meeting or a very important client dinner. And otherwise, I can. It's been shown that I can work from home. So a lot of people are making that change. So you have real estate prices plunging in the city. Let's just use Manhattan as an example, and spiking an hour outside the city. Now, that's exacerbated a little bit by, I think, the home buying is exacerbated by the fact that you've got a lot of people, maybe let's call them millennials. I don't know exactly what the um, threshold is on what their age range might be, but I would think it would be early to mid 20s to mid to late 30s, who maybe have not bought a house yet, maybe who are have been thinking about buying a house for quite a while. Maybe they've been saving. I think it's been talked about it a little bit. I think the millennials have been much more dedicated savers than people of the prior two. I don't want to say generations, but age classifications. That might be the right word. And so you have this tremendous demand for housing, and you also have a housing shortage. Let's talk about that for just a minute. First of all, these existing home sales numbers were not just specifically in one part of the country. You had 20% increases in every region. There's four, they break it down into four regions: Northeast, Midwest, South, and West. Okay. One of them might have been 19.5. I'm calling it 20. You had 20% increases in every region. All right. You also nationally, you have inventory of homes, meaning homes that are listed for sale but haven't gone to contract yet. Okay. Down 21% from a year ago. Okay. You have an unsold inventory um, of 3 months of houses on the market. Those would be houses that are listed with brokers that have not been sold at the rate that they are currently being sold. You basically have a 3-month inventory. That is extremely low. If you had a 6-month inventory, that would be considered to be a housing market that was in equilibrium, meaning 6 months, we're getting houses come on the market, we're having houses go off the market, but there's a 6-month supply of unsold houses on the market. That is what the retail industry would consider to be normal. Okay. Or a market that would be in equilibrium. With a market that would where there's a where the supply of housing is a 3-month supply of unsold houses, that is an extremely tight housing market. Okay. So you had this annual rate of sales increase 8.7%, 8.7% from a year ago. So that's up 9% in 1 year. Now, clearly, a lot of things have changed. Mortgage rates are a lot lower than a year ago, but I think the big difference is this push to move out of the cities. We've had this push for people to move from high tax states to low tax states for quite a while, really since the big tax reform act in 2017 that put a $10,000 max on what you can deduct on your taxes for an aggregate of real estate taxes and um, mortgage interest. So that really sparked that really kicked into high gear. It was probably in second gear already. Kicked into high gear the move by some people to move to low tax states or no tax states. But not everybody has the freedom to do that. But they certainly have the freedom to move out of a city that's deteriorating in social value to somewhere outside of the city, an hour to an hour and a half, where if they feel they don't have to be at work and can work remotely, it's going to be more of a win-win around them. And a lot of these people are people that never, ever could have imagined possibly working out of a city. They're dedicated to raising their kids in this city. They got their kids in decent schools. And they're just, they're probably two-income families. They're probably both, high wage earners. And now they're like, why do we have to? I'm sure you've heard some of them on TV. Why do we have to do this? You know what? We've been working home for 5 months. I guess we don't. So you've got a tight supply of houses on the market. You've got prices going up. Prices went up. Let me see here. 20%, 20% in every region. Here, year over year prices up 4% in the Northeast, up 8% in the Midwest, up 9% in the South, up 11% in the West. Pretty consistent. Northeast being the lowest rate of increase. Notice that the Northeast is probably ex-California. Northeast has probably got the highest state income taxes and real estate taxes. Inventory down 21% from a year ago. We mentioned that. Unsold inventory, 3-month supply. That is a tight real estate market. Note that lumber has, I don't have the prices in front of me. Lumber has been trading at a 1.5 to 2 year high, maybe even a multi-year high for the last, let's say, 2 to 3 weeks. Copper traded above $3 earlier in the week, backed off a little bit the last few days. It's, at $3, you can tell it doesn't have big moves, but copper was $1.80 maybe a year ago. So to be above $3, and copper is clearly, you're talking copper pipes for plumbing, a big component of the construction industry. So everything you could look at would just reinforce the tight housing market. And it's something, because the supply is so tight on the market, just a 3-month unsold supply. And I also believe that the new houses, there was one other data point, 68% of the houses that are put on the market sell within 1 month. That's a very high number also. So that is just shows that people are looking, they see things for sale, and unless there is something that really turns them off about the property, if it's, has the space they want, the bedrooms they want in a town that they're okay with, they're going to put in a competitive bid for it. So I think we can expect this housing and home building trend to continue to be strong into the end of the year. Now, why is that? What's the big deal about that? Look, I put out a fairly lengthy, not lengthy. It had 6 or 8 tweets to it. They call a thread on Twitter. Basically, a number of tweets strung together in a mini little note format. But the housing and the home building rally is perplexing to a lot of people that follow the stock market casually. And the reason is because they don't necessarily see it reflected in the major market averages. Okay. Aside from like Lowe's and Home Depot that are clearly players in the home renovation market, maybe even the home building market, every contractor is going to have an account with Lowe's and Home Depot. The big contractors, they're probably going to have an account with much bigger dedicated lumber yards and building supply companies that are away from Lowe's and Home Depot. But when they're in the middle of a project and all of a sudden they need a little bit extra plywood or an extra 4 or 5 bundles of shingles, or a little bit extra this, a little bit extra that, or something that they might have underordered, or maybe some of the stuff was defective. They all have accounts at Lowe's and Home Depot. I think Home Depot a little bit more than Lowe's does a little bit more contractor business. That's why people usually talk about Lowe's as much more retail centric than Home Depot, but they still do it. Okay. And if they get into a spot where they don't want to halt whatever part of the project they're working with that day or for 2 days until the next shipment gets there from their big lumber supplier, they'll send one of their guys to Lowe's or Home Depot and pick up whatever they need to pick up, have it there within hours so that they don't, have a 2-day delay. So, but getting back to that, the big home building stocks, they're at 52-week highs plus. Okay. The XHB is the home building index. Okay. It's got home builders in it. It's also got building supply stuff in it. I think it's got one of the drywall companies, plasterboard companies in there. I think it's might have, I don't know if it's Owens Corning or not, but it has Lowe's, it has Home Depot. I think it maybe even has Stanley Works. Because there just aren't that many big home building companies. And even if you take the biggest home building companies like Lennar and Pulte and KB Homes and maybe Hovnanian, they're not big market cap companies. Okay. I don't even think any of them are in what would be the S&P 100. Okay. They all used to be family businesses at one point in time. They expanded in their local areas, their regions. Maybe they expanded into another region also. Some of them are regional builders. Some of them are more localized builders. Some of them are national builders, but they only build, they build in a certain potential market. Like Pulte gets a bad rap on some stuff, but Pulte doesn't build real high-end stuff. Lennar is a little bit more high-end. Hovnania, a little bit higher end than that. Hovnania's always, from time to time in downturns, they have issues because they push the envelope pretty hard and they're leveraged. But they're all good. They're all decent companies, but they're not big market cap companies that when they move 15 or 20% in a month is going to drive the S&P 500 or any of the other indexes other than housing ETFs. Okay. But so you're not going to see it in the stock market other than in the prices of those individual stocks. But you are going to see it in the economic data. Because when you consider all of the tentacles that are involved in building a house, or doing a significant renovation on a house, from plumbers, the electricians, the framers, the roofers, the painters, the HVAC people, the security people that put in security systems, the carpeting people, the painter, the we did the painters, the drywall people. A lot of these places have specific teams that come in for drywall. The landscapers, the bricklayers, if your exterior is going to be brick, the people that pour the cement and do the block work if you for the foundation. It's also most of it, most areas, even the framers in a lot of cases are subcontracted. They're local skilled trades, independent contractors. And that makes a huge impact on the economy with all those people getting employed, having more work, them adding people on to their uh, staff, to their crews, and it also then it fuels the delis and the restaurants where they go. A lot of them get takeout food for lunch, et cetera, et cetera, et cetera. They buy more. They buy more gasoline because they're driving their trucks to the work site. More people are going to the work site every day. It can be when the housing market and the home building market is really in gear, like it was from, like, let's say, '03 to '07. It can be 15 to 20% of the overall economy. Okay. So, sure, it might be a real hurdle for the airlines to get back above 50% capacity, for all the indoor activities to get back to where people are comfortable going to, you know, restaurants, bars, sporting events, et cetera, et cetera. Uh, Housing might pick some of that up. They might pick up some of that slack. I am sure you're probably already starting to see it if you look at construction numbers or some employment numbers being buffered by what makes the headlines every day. So this is a big, big part of the economy, but not a big market cap effect on the stock market. That's my real point. Now, getting back to the stock market, I mentioned the Russell was down today. It was down yesterday. I think it's been down 3 out of 4 days. The advanced declines were negative by 2 to 1, both at NYSE and on NASDAQ. Crude oil, 42.30. I think that's positive, still holding 42.30. But the market, to me, didn't act that well. Let's put it this way: the rally is becoming more narrow. Okay, when you have the S&P and the NASDAQ both posting new all-time highs, the S&P scratching at that 3,400 level, and you have the Dow up 200 points, again threatening the 28,000 level, and you have twice as many stocks at the NYSE declining than advancing, and the same on NASDAQ, it's not really a positive. It's not a positive picture. It just means that, I mean, look, there's always been these 8 to 12 stocks that are driving the internet traffic trade. Okay. But then there's been a lot of other stocks have been rallying also. So you've had good breadth numbers. You've had good market internals, even on days when the NASDAQ significantly outperforms. But you've also had NASDAQ advanced decline, up 2 to 1, up 2.5 to 1, up 3 to 1. Although some of those stocks are, under the radar a little bit. Not the big market cap stocks, so they're not going to push the averages. But the NASDAQ, but these down to advanced declines down 2 to 1 on a day when the Dow's up 200, the S&P is and the NASDAQ are posting a new high. S&P up 0.7%, 0.75%. NASDAQ up 2.6% on the week. I don't like it. Look, now that could straighten out. Next week we could be fine. We could work our way through it. But it bothers me. I've talked about TSA numbers a lot. That's the airline. That's the checkpoints at the airlines. They tabulate. They put up on their website what their checkpoint numbers are every day. I don't think we talked about it yesterday. And you had, I don't think we did a show yesterday, actually. So Wednesday, the checkpoint numbers, and Wednesday's the second slowest day of the year for at the airports. Tuesday's the slowest. Wednesday, we had 586,000 people go through TSA checkpoints. A week ago, we had 590. That's down 4,000. Look, it's one day. Most week over week comparisons have been positive, but it's going in the Thursday, much different than Wednesday. We had 772,000 people go through TSA checkpoints at the airports. That's up almost 200 from Wednesday, but that's typical because Wednesdays are that's why you're always going to get your best fares if you're flying and you have flexibility to fly any day of the week. Fly on Tuesday or Wednesday. That's when you're going to get your best fares. So Wednesday, we had 586. Thursday, 772. 772,000 people go through checkpoints at the airports. Versus a week ago, that was at 761. It's up 11,000. It's like up 1.5%. It's just not enough. You saw the airlines have that nice 3 or 4 day rally. It looked like they were maybe going to just consolidate a little bit and then make another move up. They haven't done that. The numbers just aren't, we don't have enough growth yet in those airline traffic numbers. So 7:35, we've got a couple of minutes still. Anyone has any questions, any comments, anything you want me to touch on, throw it in the chat and I'll give it a shot. Rick, I'm sure there's half a dozen things you'd like to talk about today. So the DNC convention wrapped up last night. The Republican convention will start Monday. And then I think we'll get into really the blood and guts of the campaign. We'll see if a lot of the polling changes from registered voters to likely voters. A lot of the polling has skewed heavily toward Biden, I think, because they're either polling all adults or they're polling registered voters. And of course, anybody that has a 3rd grade, 5th grade knowledge and above of polling and elections knows that unless you're really getting a good read on likely voters, the polling really doesn't mean a whole lot. So we will see where that goes. I think you're going to see Trump be very active out on the campaign trail, visiting many different parts of the country, even if he does not have large rallies with 15 to 20,000 people in attendance. You're going to see him a lot of places, and it'll be interesting to see how many places you see the Democratic ticket of Joe Biden and Kamala Harris at. But if the market has been all affected by the election so far. I think it's been in the weakness in the energy sector, given the Democratic platform basically coming as close as they possibly can to endorsing the Green New Deal and elimination of fossil fuels without really saying that. And also the financials significantly underperforming. They had a nice rally about 2 weeks ago and couldn't build on it at all. Some of them, the big money center banks, might even be lower than where they were uh, before that rally 2 weeks ago started. I do not have specific sector performance for the week down yet. I mentioned crude oil. Gold had kind of a flat day today, a little bit of volatility this week. It's at around $1,950. Silver at just below $27. That's on the futures. The cash is probably $1.50 lower. Silver at 26.88, just below 27. I think that you're still going to see some action in both of those. Silver has had the higher percentage moves than gold. Gold is a lot more tradable. A lot of people would rather trade that than silver. But we'll see. We'll see how that plays out. And the other interesting thing, kind of cool, little bit reinforcing my anxiety over the fact that the internals of the market vastly underperform the market averages. I would say the second half of this week, and in a glaring way today, being with 2-to-1 decliners, where the major market averages, aside from the Russell, were up. The VIX contract, one of the main traded VIX contracts, closed the day Thursday at 20. That's a volatility contract, but really it's a bet on volatility to the downside. Closed the day Thursday at 24.50. Closed the day Friday at 24.65. So that's only about a 15% increase, meaning a little bit more, some people were a little bit more anxious about maybe the market taking a significant dip for anywhere from a day to 2 to 3 days to maybe a little bit longer. Typically on a day like today, when the Dow is up 200 points, the S&P, and this is a VIX contract specifically tied to the S&P 500. The S&P 500 was up 0.7%. It closed at a new high, 33.97, scratching that 3,400 level. And the VIX contract that's tied to that S&P, which is a bet on the downside, also finished the day Friday higher, although only by 15 cents, than it did on Thursday. Typically, you would see the VIX today lower than what it was on Thursday because the S&P rallied and closed at a new high. So, look, I'm not making any predictions. I'm just saying that for those people that read a lot of commentary on the market over the weekend, you're going to read a lot of people that are nervous and or reiterating how that the market's overbought, because a lot of people have been saying that, and Ben hasn't played out over the last 3 weeks, that the put call ratio is very low, that you'll see numerous comparisons to other points in time when the market then had I'm not saying the bull market ended, but you could have a 2 to 3 day, 3 to 5 day, 1 to 2 week sell-off. Now, things seem to be so compacted, it might only be a day and a half. I mean, when I say mean compacted, I mean You used to have these market events. The market would sell off for 3 weeks and then recover and then rally to new highs. Now all that gets compacted into 3 days. The market will sell off. A decent sell off in the market is down one day, down again the next day, down again the following morning. Then the market bottoms, recovers, closes unch or slightly positive on the third day, and then rallies, the next 2 to 3 days. That used to go on over a period of 3 weeks. It now goes on over a period of 3 or 4 days. So these moves are compacted, they're sharp, they can be violent on occasion. I'm not predicting that. I'm not saying you should bet on it. I'm just saying a lot of people, you will have more people talking about the market being extended, bearishness being very low, bullishness being high, exuberance factor being high. You'll see different indicators with different names on them, all consistent with the fact that we're extended and due for a 1 to 3%, 3 to 4%, 3 to 5% correction. Whether or not that really happens, you can be in that state and have the market kind of consolidate and churn through a challenging stretch and get through a few challenging resistance levels, and then it goes away. That's happened a lot of times. It's absolutely frustrated the hell out of the people that are bearish on the market. A lot of you people know who Dennis Gartman is. He's been bearish and changed his mind over and over and over again. He's almost like he's thrown in the towel a couple of times. You can sense his frustration to the point where he's just saying he's not going to fight it anymore. That doesn't mean he's bullish, and that doesn't mean he's long the market. But he's tired of making bets on the short side and having them not play out. Anyway, look, it's a Friday night. It's probably going to be a pretty good weather beach weekend late in August. I hope everyone enjoys themselves. I'm a little bit 50-50 on a show for Sunday. If I do it, it's going to be 7 o'clock. I just got to get back. I just got to get to a good location by then to do it. I was maybe going to do it at 9 o'clock on Sunday to give myself a little bit extra cushion on time. I don't know if that's too late for people or not, but I really appreciate everybody watching. I appreciate everyone's support. I love getting the questions on Twitter and here in the chat to address, because a lot of the questions from people are very good. This is the Anderson Report. I am Tim the Source Anderson. Everyone have a great weekend. You can always watch this on replay if you didn't catch it live. You can watch it on Periscope, TJ Anderson 12. And my Twitter handle, of course, is TJ Anderson 1. Have a nice night. Have a great weekend. We may or may not be talking to you on Sunday. I'll alert everyone by noon on Sunday whether or not that's going to happen. All right? Thank you, everyone.